So China index inclusion is perhaps one of the most important changes for the global investment industry in the next decade. And what this means is that today, China already has the second largest domestic stock market globally, with about $7 trillion in total market cap. That market is not part of the global index system, such as MSCI or FTSE. This means that the majority of the global investors today are not investing in China properly, or in fact, they may have an under-investment issue with respect to Chinese equity because it's not part of the benchmark bet, not part of the system they are using to make investment allocations. So if this index inclusion happens, will make China equities officially part of their benchmark. And we estimate there will be around 640 billion of US dollars inflow into the Chinese equity market. This is by all means a very important change. I just spoke about the flow in terms of the capital flow into this market if this index inclusion happens. That's with respect to both MSCI, FTSE, and other index providers if they move ahead with that change. On top of that, you will also find that most global investors today, like I said, face many challenges accessing this market. That challenge particularly come in the forms of market access as well as investment management. So I think once the index inclusion happens, the next thing the global investors need to consider is how to generate alpha in this market. One very simple truth, this is a very broad market with over 2,900 stocks. And if you only invest in the index names, you're not going to get much exposure or the proper exposure to the Chinese economy. So you really have to think about how you broaden your exposure, structure your portfolio properly, and understand all these 2,000 or so stocks so that to pick among them and build the portfolio that's right for you. We generally categorize this as the globalization of A-shares as a theme for the domestic A-share market today. Today, the foreign ownership of A-shares is only 2%, versus in India is 24%, in Korea is 35%, and in Taiwan is as high as 40%. So this 2% foreign ownership Chinese equity market will definitely go up in the next few years as this index exclusion happens, as the globalization of A-shares happen. And we expect this will lead to significant changes into the domestic Chinese equity market with respect to a few areas. One is the volatility, the other is the correlation with global markets, and perhaps most interesting is the change in the style and investment preferences. For example, we expect the value investing style will become more prominent in China as more foreign and global institutional investors participate in this market. In fact, we have already seen high dividend yield paying stocks doing very well in China since the market crashed last year. And that could be a sign that the market is already beginning to mature and have more institutional participation.